This podcast is for informational purposes only and is not an offer or solicitation of any offer to buy or sell securities. SNN.Network and Maj Suedan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Everybody, welcome back. This is episode 2 for Avoiding the Crowd podcast with Maj Suedan. I'm your the producer, Robert Kraft. Maj, host, say what up.
Hey, Bobby. Hey, everybody. Thanks, Bobby, for waiting for me today.
Oh, it's my pleasure. I love just waiting around for you to record an episode. It's all good. yeah, we're only on episode 2, and I'm already waiting around for you for.
I told you I was on a conference call, but in reality, I was kind of on a conference call, also eating a calzone. So sorry.
Oh, so now the truth comes out. That
was about 15 minutes of the delay. Yeah.
It was the calzone.
A little bit of it. I was on the Crescendo conference call though. It went a little longer than I thought.
Okay.
I decided to eat a little bit of food while that was going on.
All right. I guess, you know what, I'll take it. Look, you got to refuel a little bit before you come on here and we give you a hard time. So I appreciate that. I mean, was it as good as the calzone that Kramer used to get, that George used to get, George Steinbrenner, during Seinfeld years, or was it a better calzone than that?
Nah, it's Florida, man. Florida doesn't make Italian good. So.
So then why torture yourself? I mean, come on, that's just empty calories.
The best I could get.
Come on, man. We're in quarantine, dude. The pounds don't just shed themselves. Okay, you have a calzone that's not good for the insides. What are you doing?
A little treat.
Nice, dude. Well, I appreciate you. Doing episode 2 today. That you came back to do this. That you weren't so annoyed with me from our first one, and also thank you everybody that listened to the first episode. I promise there's going to be a lot more than just me giving Maj a ton of shit every week. I swear. Even though he asked for it, it's not my fault. He asked for the shit. What am I supposed to do?
I'm okay with that.
I figured. So
respect your elders, man.
What?
Respect your elders.
This is true. I'm so sorry. I take everything I said back. You eat that calzone. But anyways, man. But how you doing after last week? I look, at the same time, I hope nobody's sick of you. Not only do the episode, then you also moderated a panel last week. I mean, this was a lot of Maj last week.
It was fun, man. I guess your conference was good. I mean, I had a few companies that I liked that I guess we'll talk about. So that was good. So yeah, it was about a busy week last week.
That's for sure. And you also said offline that how's your back doing? You apparently also threw your back out with the calzone, or is this? That's a different thing.
That's a different thing. Lifting the calzone, and I threw it out last Tuesday, just tying my shoe. But I did deadlifts the day before, so that's what I'm going to go with when I'm out in bars and stuff. So.
Deadlifts just your own weight, just doing your deadlifts with your shoes, and that's
just looking tough. Yeah.
Jesus, oh my gosh, we're a mess. We're gonna sort you out though soon. But yeah, let's get to business, man. In the last since last week, we didn't talk about your most recent weekly wrap up. I wanted to cover that with you real quick. So you on August 2nd, you put out in your weekly newsletter about should you practice diversification or concentration when you invest? And this is just the age-old question that we all love to ask, and the time-honored tradition of podcasts and investing media talking about diversification versus concentration. So I figured, why not give Maj his 2 cents? So floor is yours, man. You want to kick it off, give your 2 cents, and go through some of your thoughts on this?
Yeah, and as a reminder, every Sunday at Geo Investing, we write a weekly wrap-up email that goes into everything we did during the week, and also includes some stuff we didn't talk about that comes into our research pipeline, or stocks we're looking maybe to buy or adjust our positions in. And we usually kick off that weekly email with an introduction with maybe some educational stuff, sometimes a pick. But the topic last week last Sunday was about diversification versus concentration. And really, I know I don't think there's any right answer to that. So I kind of get like a little annoyed when some people say, "Oh, the concentration is the way to go, diversification is the way to go." Really, a lot of it depends on the person's personality, your own investing style, and even the market environment. Sometimes diversification works good, and sometimes concentration might work good, depending on if your style of stock picking is in favor, not in favor, or just as you're trying new strategies. So one thing that kind of irked me a little bit is, Buffett's is out there and, the common theme is that Buffett is this investor who just like thinks, diversification is for, the ignorance. I guess he has a quote where in fact, if you are doing your research according to Warren Buffett's, there's no need for diversification at all. At the 1996 Berkshire Hathaway annual meeting of shareholders, Buffett declared that diversification is a protection against ignorance. And I think a lot of times that's kind of quoted out there and people talking about it. But actually, when you go back and look at some of Buffett's, an older video from Buffett, he actually talks about, he kind of qualifies that. If you're, the average investor maybe not really intense on doing research, just want to get there and invest and get exposure to the market, diversification is definitely what you should be looking at. He's like maybe 98% of the people, should be doing that. If you're not really looking at stock picking or doing big research into stocks you're buying, maybe you buy index funds, buy mutual funds. So then I got it. I got what he was saying to some degree. But he's saying if you are going to take a step, for example, be a full-time investor and start doing deep research, it doesn't make sense to have more than like a few stocks and continue to invest in those stocks if it's the right company. So you would say, like, it doesn't make sense maybe adding a fourth stock to your portfolio if the other three stocks are still as good or getting better. You put more money into that, those three stocks. That's kind of what his mantra was, which I still want to see what he's saying. But again, diversification versus concentration also depends on your personality. I think it's, Peter Lynch owned, hundreds of stocks. And so she proved that you can make money with a diversified portfolio. I think it really all comes down to how well you are as an investor, and if you can find that many good stocks, and your personality. So it's really the cowboy mentality to be this concentrated investor. It's cool to say I'm a concentrated investor, I own 3, 4, 5 stocks, and that's it. But it's great if they go up, but if you're wrong, right? On a very concentrated, let's say you only have 2, 3 stocks, and you end up being wrong. COVID hits, and all of a sudden all your stocks are, going to get hurt because of COVID, or maybe long term, then your portfolio is destroyed. So you got to think about those things. And you also got to think about your personality. Being a concentrated investor means you have to have, incredible nerves of steel to maybe be able to ride out, bad times in 2, 3 stocks where you don't have a lot of diversification in your portfolio to be able to offset that out. So you have, so I think a good kind of, and I talk about it in the article, a good type of number, I think it's 5 to 12 stocks maybe, or was it 5 to 10, somewhere in that range, depending on where you are. So if you have a high tolerance for risk, maybe 5 stocks is good for your core long-term portfolio. If you're not, maybe go to 12 stocks so you have a little more diversification. And that's kind of the way I look at it. But you look at Peter Lynch again, and he was able to average 29% a year for 13 years. On a multi-billion-dollar fund with hundreds of stocks in his portfolio. So it is possible to do well and beat the market. But I think just the point I want to make again, but I understand now where you understand where Buffett's coming from, right? So when I first saw that protection against ignorance quote years ago, I was like, I was pretty pissed off. What is he talking about? Then when I saw his previous video about him qualifying it, I understood what he was talking about. But again, so either one's going to work. Buffett's been a great, is a great investor. Lynch is a great investor. You find the style you're comfortable with and go with it. Now, in terms of myself, as I invested over time, I become more of a concentrated investor. There was a time where I owned like 300 stocks when I first started investing, like 30 years ago or so. And as I was a lot more short term back then, so I was doing a lot of flipping and stuff, and still buying high quality companies, but a lot of turnover. And I wasn't really as good at analyzing companies, so And there was no need for me to really concentrate because that was a great time investing during that time. Back in the 90s and stuff, you could just find a lot of great stocks. It was less skill and more just everything going up, and even most of the 2000 area. But then 2008 came along, and we had the recession, and a lot of that strategy wasn't working anymore, and it forced me to dig a lot deeper into companies, and I really started enjoying doing that and looking at stocks from a longer term perspective and looking at wealth creation from a longer term perspective. And I'm convinced that finding that core that you like, 5 to 12 of great long term companies that that you're going to be able to handle volatility in the market, and then around that these short term, maybe a lot more short term plays if you want to, especially if you're a full time investor and you're trying to make some extra income on the side. That's kind of what we talk about in the article a little bit, and I go a little deeper into it. But again, it all comes down to find your own, what we connect with, experiment with things. And I think either way works. You can be a concentrated investor or diversified investor. Either way works, but understand the pros and cons of both. I think it's important.
So Maj, one quick follow-up to this is, and I don't know if this has been talked about on other podcasts, I'm sure it has been, but are there different personality traits that you think work better for having a successful diversified portfolio versus a successful concentrated portfolio?
I think the key, I'm not expert on personality traits. I wouldn't know how to answer that in terms of that way, but I do know this, or I feel this is the case, is that the better you are doing research and the more you dig into the companies you own, the more concentrated you can be to some degree, because you're basically flushing out that risk by understanding your risks and really getting into a company. And the less ability you are doing research, the more you might want to protect against unforeseen events in your portfolio by having a little diversification. And look, and also just point out this too, whether you have 200 stocks or 5 stocks, when the market's crashing, they're all going to go. You might lose.
Doesn't matter.
Yeah. So in either case, you have to be emotionally strong to handle those things and do things to help you cope through that. Just a little more risk in a concentrated portfolio if you're wrong in your research, that you can decimate it to some degree. I'm just lucky enough that I've always had some diversification, so I've had a really bad stock pick or two. But I've been lucky enough, knock on wood, that the other stocks, that had were more offset those things. And that's because the nature of how that works. When you lose stock, you can lose 100%. You make money, it's infinite. So you don't need as many.
Absolutely. And might I request, will you stop hitting the damn table every time you make a point?
I was knocking on wood.
Oh, that was not, you knocked on wood every time you said something? I mean, geez. Come on, man. You stop hitting the desk. I appreciate the passion. I appreciate your passion. Here, look, this is how it sounds. That's how it sounds. Yeah.
Where that's coming from, man? Must be you.
It is not. No, it's not me. It's you. All right, man. I want to get to your letter from yesterday that you posted. It wasn't so thematic, but you let everybody know that you have an interview coming up that you just did with the Gladiator HC. That's at the Gladiator HC on Twitter. I actually just did an interview with him on Planet MicroCap, and he's an awesome interview. Like one of really a good one. And so I'm not sure. Did he publish it yet? I don't think so.
I think he's publishing it tonight.
Tonight? Oh, okay. So everyone will be able to check that out. I'll put a link to it in the description of, if it's live, I'll put it in the description. But yeah, so I invite everybody to go check that out. You also mentioned in this newsletter 4 new stocks enter the research pipeline for Geo. So you want to get into this a little bit?
Yeah, sure. Like I said earlier, the weekly email usually has this intro, and then we talk about research pipeline, new ideas, and sometimes we're light on the weekends, and sometimes we have heavy research. This is one weekend where we had 4 stocks we wanted to take a closer look at. And 2 of them came from your conference, one-on-ones I had at your conference. Oblong, I think OBLG, and the other one is Thunderbird. Is it Entertainment? I think is the name of the company there. It's a TBHRF or THBRF. I think, let me say.
TBRD on the venture.
Yeah.
Yeah.
I'll make it both.
Full disclosure, I'm not a shareholder in either of these companies.
And I am not in either of those yet. I'm trying to get them here. Interesting. Well, yeah. So you have the symbol. Maybe you have the symbol in front of you. There's a 4 levels. There's an OTC symbol too, or a
So on the venture it's TBRD.V, and then on OTC it's THBRF.
Yeah. So let me pull that up real quick. I don't have that quite in front of me yet. Give me a second, Bobby.
I guess I'll have to fill time here or edit. I'm not sure. Maybe I'll just keep in the fact that I'll say I'm going to edit it and not edit it.
Thank you.
Or just pretend I'm in the barrel right here while you're doing you're being so unprepared for our podcast today.
This is true.
For those just listening to this, my screenshot is me inside of a perfect barrel, which I wish and hope to be surfing at some point this week, because there's finally some swell that's hitting Southern California.
So I got it up here. Actually, well, I can do that. Actually, even the stocks, we covered a lot of stocks this email. Besides that, we covered Asian Information Software, AIFS, which is a library software management company, high recurring revenue. Mechanical Technology, MKTY, defense company, KRMV, IEC, which did they come to your conference or not? They did not. They weren't there, right? Yeah. Really love that company. EDUC, EML. So we had covered those during the week, and then we decided to add 4 more symbols in the mix here. We do that to be very early in our transparency with our membership base. Hey, these stocks are entering our pipeline, and then every day or every week, or we start kind of feeding our due diligence to our members what we're finding on these things, and then if we wanted to start, building a position in them. So again, OBLG, it's a video collaboration company where they offer tools to help companies during video conferencing and these kind of things. And that was, it's a turnaround company, and then they have a new CEO and trying to turn the company around. They haven't had great success, I think, in the past, growing the company profitably, and this CEO thinks he can do that. So it's a pretty hot sector now. It's not UCaaS, Unified Communications as a Service, but it's in that same area of kind of remote working kind of thing. So I'm going to kind of peek by that to learn more about that. The other one was TBHRF, was a profitable company that provides content to streaming services like Netflix, for example, and THBRF, and they are profitable. And I really enjoyed that interview, and they've been growing revenues pretty steadily. They're profitable, and it appears that growth may accelerate. The CEO had a really good handle on capital structure and really believes in preserving, shareholder value by not, diluting shareholders. I like that. Really get into that a little bit. So that was good there. And then we had Video Display Corp, VIDE. It's a company I followed years ago, and they never really got things going. It's a video display products and panels, and they have, I don't know much about it. It's changed so much, but I noticed I took a quick peek at it. I wasn't going to put it in the email, but I said, let me get people ready for it, because it was some informational arbitrage. They don't really release any press releases, so I found some information in their 10Q and 10K talking about their turnaround, which seems pretty interesting. And so I want to dig into what's going on there. I think they might be strengthening their relationship with the government and getting new contracts there and higher margin products. I want to see if there's a COVID play here because of the video display type of advertising. I don't know. I really don't know. I can't tell you, but definitely they are trying to reinvent themselves. And they had a pretty decent core improvement in revenue, and I think their loss was reduced. So you have to excuse me for not knowing much about it, but that's what we do too. We even bring these companies in really early before we dug into it. Just a lot of times our members help us dig into it, or a member might recognize a symbol, shoot us an email and say, hey, like there were even OBLG, one of our members say, hey, by the way, they wrote the stock up. So they sent me their notes. I'm taking a look at that right now. So we like the collaboration among our members. So that's, in the next few weeks we'll be bringing some due diligence on that. And regarding AIFS, which is the I mentioned earlier, the library management software company, we have a full article on that we're publishing soon. But there's some loose ends for time there. And we have some problems in finding out how many libraries have adopted, how many states have adopted some of their solutions. There's some kind of contradictory information on their website versus my first interview a while ago. So before we publish a report, we're trying to kind of dig into that a little bit. That'll be an interesting company to discuss maybe on one of your next podcasts.
You know, I'm one of your this is your show, so I'm one of your next episodes. I know this is still new for you, still getting used to it. I can feel it. I feel you're getting your bearings. It's good. I like it. So I mean, was there anything in particular about these companies that stood out to you, or you kind of just went through them more or less?
Well,
I mean,
on the ones in your conference, yeah. I mean, well, at least on what impressed me with the TBHRF, Thunderbird was again the CEO's attention to capital structure, and and I obviously like the area. I mean, providing content. And one thing I didn't want to dig into that, providing content to these streaming services like Netflix and even Disney and these other services. I worry about can it be a choppy type of revenue stream, and what happens when some of these, how does the revenue model work, or how long do these relationships last? So if Thunderbird sells a piece of content to a Netflix, they're either going to rent them that for a few years, maybe 2-3 years, or potentially Netflix will buy it. And I want to understand that process a little more, and what happens. What does Thunderbird do if when these, how many times has Netflix upped a 2 or 3 year type of contract to see how recurring some of these relationships can be, and if you don't have a good pipeline, you start getting lumpy revenue. And I just want you to understand that Netflix model works, right, and how that can be a very nice repeatable business that you can easily kind of forecast. But content providers haven't really been attracted to them, but they seem to have a really good pipeline, good relationship with Netflix, and really trying to expand relationship with other streaming services. So there could be a predictability element to this that I might like, actually. With this particular company in general.
Right. I mean, maybe we should do an episode at some point on some of these different business models as well. Looking at content creation and streaming services, kind of how all that works. I mean, especially with COVID-19 and all these different, not only content plays, but new Zoom-like companies. It's pretty interesting. SaaS models. We just talked about that on the Investors Roundtable last week. It's kind of interesting just to see, I mean, where technology is able to take us in times of pandemic, right? So it's pretty interesting. Not to expect that there's going to be another pandemic-like event in the near future. I hope this is it in our lifetimes. But hey, it's one of those things that I remember Andrew Kuhn and Jeff Gannon even said on last week on their roundtable. They said, literally the week before they, I think, sold one of their portfolio companies, they asked themselves a question: hey, would this do well in a pandemic? What happens if there's a pandemic?
Right.
I wish. How many people are asking that freaking question, right? I mean, it's crazy.
It's not necessarily bad. I mean, look, COVID-19 is horrible, but it's not the fact that some companies are trying to make our lives better and easier and solve problems is good. Unfortunately, some companies die, but many companies are reinventing themselves too. If you were a company transitioned to online, maybe your business has progressed even faster than you thought. You're providing a service to consumers and making our lives easier. So that's something to consider.
Or you're opening up a whole new vertical like Kodak. I mean, they're now in the biologics space or
Oh yeah, well, Kodak, that's
yeah, right.
Yeah. But the thing is, we got to be careful too. Is what I worry about sometimes when I'm looking at some of these stocks, you start finding out that like UCAS, for example, or SAS, it's getting sexy and everyone's getting into it, and you got to try and navigate that space to see maybe the top 2-3 companies in the space. There's a lot of Me Too guys out there, and a lot of companies will try and play that, SAS and UCAS kind of language just to get their stocks pumped up. And the space is getting competitive, and it's really important to find a few that have competitive advantages. We can talk about that too at some point.
Absolutely. Well, yeah, I think that's a good way to wrap up this episode. Where can everybody go and find more information about you and follow you on social media?
Yeah, so geoinvesting.com is where you can learn more about what our service will we do. We have offer a 7-day free trial, and we have different memberships. We have a monthly membership, an annual membership, and a biannual membership. And the other memberships allow you to anytime have a Skype conversation with our team as much as you want. There's no limit to that. And of course, get all of our services that, our research, our call to actions, and all our updates. You can follow me on social media on Twitter at Maj GeoInvesting. You can follow GeoInvesting at GeoInvesting. And you can reach out to me, Maj at geoinvesting.com, or call me at 267-246-3263. So
that's actually that's his burner account. This is burner number right there.
Okay, I better get one.
Well,
no one's calling me top microcaps. I'm not worried. I'm getting a ton of robocalls now, though. I don't know what you're doing.
Oh man. Yeah, right. I was just going to say, we got to get that download count up. Once you're getting that 1,000 downloads, you ain't going to be giving out that number anymore. Or maybe, who knows? Maybe you should. That'll be our KPI to see how successful the show is. Well, with that, what's up?
Yeah, you're right. Yeah.
And Maj, real quick, for full disclosure, do you own any of the companies that were mentioned on this podcast?
I do, and I guess I can name the symbols: AIFS, I think IEC, EDUC, and EML. I believe those are the only ones I mentioned that I own right now.
Yeah. All right. Well, let's wrap it up there. Maj, always a pleasure. Full disclosure, I or SNN are not shareholders in any of the stocks that were mentioned today on the show. Again, my name is Robert Kraft. I'm producer of the show. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And this has been Avoiding the Crowd podcast with Maj Soueidan. You can follow us and subscribe to the show on Apple now, and also on Apple, not Apple now, Apple. And also on Podbean, which is at avoidingthecrowd.podbean.com. And thank you all for listening, and we'll see you next week.
Thanks, Bobby.
This podcast is for informational purposes only and is not an offer or solicitation of any offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.